with Us versus Her. Today I want to go over some things with the Robinhood and options trading, just some tips and some things that you may not know of. This video is geared towards more of the beginning trader. A lot of people that are on Robinhood are beginning traders, mainly because of there's no fees and the way that Robinhood targeted people or new traders. I would say that though, kind of a disclaimer for options trader is that options trading isn't for the beginner. I know that Robinhood added it to their platform and they try to make it very user friendly, but options trading is really not for the beginner or for the new investor. If you're just learning, definitely paper trade before you start putting your own money towards options, because the pricing on these are violent. You could easily make money. You could also very easily lose money. So you'll probably lose more times than make money just because of the way these trade. And you're trading with an option contract, so you're going 100 shares leveraged. If you don't know what you're doing, you can get margin called. Some crazy things can happen here. I'll go into SPY. I'll use an example. Kind of the first thing that I want to point out is today is expiration Wednesday for SPY. So SPY, they have options expire every Monday, Wednesday, and Friday. Most liquid stocks expire on Fridays. So like Apple, Amazon, Square, Tesla, they all have Friday expirations. So they have weekly expirations, also monthly options. But SPY, because it's so liquid, it has Monday, Wednesday, and Friday. And one thing that I want to point out is that Robinhood doesn't allow you to trade the day that it expires. So like if you look at the grid here, the option I get is August 3rd here, and on Thinkorswim here I actually have August 1st. I could actually trade today. Today is August 1st, Wednesday, August 1st. So I was actually able to trade this. And the reason why that's important is if you're looking to get some cheap options that's going to move quick that day, you could definitely day trade that. You can definitely close positions out. So if you had something open for August 1st or today expiration, you would definitely be able to close that out. But you wouldn't be able to open any new positions, because if you said, hey, I have this position, I want to add to it, looks like it's going to break out really nice today, I can make 400%, 300%, whatever the case is, you wouldn't be able to do that. You'd only have to be able to close your existing position. So just a heads up regarding that. The other thing is that the trade grid here isn't it's not as nice here. But before we get into that, I want to also say that if it does expire today, and it's in the money or it has value, they'll cash you out. Robinhood will cash you out an hour before close regardless. And the reason why they do that is to mitigate risk towards the brokerage. They're a new brokerage. They don't have as much capital as some of these bigger firms or like E-Trade or TD Ameritrade. So they kind of automated it. So they said, okay, at 1 hour before close, if the account has value, whether the contract has value, whether it's in the money or out of the money, I'm going to cash this out. So just be wary of that. Like if your option has value and you're like, okay, it looks like in power hour here it's going to run up or it's going to run down, whatever the case is, it's going to swing big in power hour, they're going to cash that out for you. And when they do cash it out, most likely it's not going to be in your best interest. So just be aware of that. The trade grid here, it's pretty simple to use, but the one thing I will say about the trade grid is this break-even price, and I know we've gotten a lot of comments about this. The break-even price isn't the break-even price of the options contract. It's only if you exercise it. So they're saying right here, so let's go to the 281. So this 281 call is 87 cents. To be break even, you'll need the stock to go to 281.87. And what that means is if you own 100 shares of stock, you'd have to pay 281 plus the 87 cents to break even. This does not mean your options contract. It depends on implied volatility, implied theta. It could go to 21.87. You're like, hey, I'm losing money, or you could be at 21.87 and be like, hey, I'm losing money. Why is that? And that's mainly because this is for the stock break-even price. If you own the stock, if you own 100 shares of SPY at 281 and you paid 87 cents for the contract, you need to go to 281.87. That's if you owned it. Now, if you depending on how this moves and the way the chart works, you'll definitely be break-even before that. if you, this expires like August 3rd, so it really depends. But this break-even price, don't get stuck on that and don't trade based on that, because it's not likely you're going to exercise your option. I mean, do you have 28 grand laying around to exercise and buy 100 shares of SPY? Probably not, especially if you're a beginning trader. If you do, great. If you want to hold on to it, great. But most people, when they buy options, they just trade the options contract, mainly because that's where they either make the money or they lose the money. Because not only did you have to pay to exercise this, not only did you have to pay the $87 to exercise it, to own it, then you got to tie up 28 grand in capital. So most people just trade the option pricing here. The other thing is one thing that I like about other platforms like Thinkorswim or Tastyworks is there's no probability of in the money. So a lot of times what people will do is they'll just say, hey, I'm just going to buy something cheap and hope that it goes in there, not really thinking it like these 283.50 calls for $11. And like, I'm gonna buy a bunch of these, I'm gonna get rich, and not really realizing how option pricing works. Like, you can't just buy things and hope to get rich. There's 283.50s. If I look on Thinkorswim platform for Wednesday, these 283.50s, they have a 10% chance of it being in the money. So they're saying you have a 90% chance that this is going to expire at zero. So as you can see here, when option pricing gets more expensive, the probability of it being in the money or being worth something is better than these being out of the money. They have a higher probability of being worthless. As you can see here, if I look at the probabilities for August 3rd, they're saying actually some of these, I don't know why they would calculate this 100%, but these 278s, they're saying there's a 100% probability that these are going to be in here. Now, I would say this is not entirely accurate because anything could happen in the market, right? So you're like, hey, if I'm going to buy these right here, there's a 100% certainty that we're going to make money. They're just saying it's 100% certainty it's going to be in the money. It doesn't mean you're going to be at this price. If it expires at 278 and a penny over, it'll be in the money, but you wouldn't be making any money. You'd be making, what did it expire? Let's see what these 25 cents. So you would lose. It would go down from. Let's see. It would go down from $3 down to 25 cents. Yeah, it expired in the money, but you lost all that. You lost all that between that. So you lost $275 on that, $275. But yes, it did expire in the money. But I just want to show you what the probabilities are, because when you play options, it's about probabilities and it's about being right and having the timing right. And a lot of people say you can't time the market, you can't do this, but when you trade options, it's about speculation. It's not necessarily about being right, and it's about having the timing right or having enough time to get out of the trade with the goals that you put on before you place the trade. So, definitely when you have a trade, always have an exit strategy, always have an entry strategy, just because, these things are volatile. As you can see, they can go from $3 to 25 cents like nothing. So, and if you traded these before, you definitely know what's going on here. For credit spreads, it's definitely not very easy to trade credit spreads over on Robinhood. Like on Thinkorswim, I could just right click on it, say on these puts, and sell a vertical put spread, and it'll automatically create a credit spread for me. So one tip that I use when I'm doing something on Robinhood is, let's go to the puts here. And one thing I don't like is that they change colors based on how green or red it was today. So today was a red day on SPY, so they made the puts green, even though these all lost money. And then they made the calls red because the stock was down. So the calls, not great. And this kind of flip flops every day. So it's not really a consistent feel. So for like a newer trader, it's definitely not a consistent look. But for puts, so when you sell a vertical put spread, it means you want the stock to go up. When you sell a vertical call spread, it means you want to go down, because it means you're not buying options, you're actually selling them. So I actually am short this price. So instead of buying, let's say this 281.50 put for $1.14, I'd actually be short it, meaning I want it to go down to zero. You can sell naked, but what we'll do here is I'm just going to put a vertical put spread. And like over here, you can see highlighted in yellow. This means in the money. This means out of the money when it's white. Very nice and clean. You can easily identify that. When you're in Robinhood, you can't easily identify. Yes, they put the share price here, but when you switch between calls and puts, you gotta really be on your toes on which direction you're doing, especially if you're trying to put the trade on quickly. If you're trying to put the trade on quickly, I don't think Robinhood is the platform for that because it's easy to make mistakes. So, and they also highlight the buy button first. So what you want to do is you always want to sell, so that way you remember, you want to sell the more expensive option first and then buy the cheaper option. So if you look at option pricing here, and then you can determine what kind of spread you want to do. So don't look at the price, when you're trying to put a vertical put spread on, unless you're trying to meet some goals and trying to remember what it is. But what I always do is I look at the price and I sell the most expensive one first, which we'll just pick this one that's just in the money here. 281.50. So I'm going to be short it, and then I will buy it, the cheaper option here, and then you can play around with the numbers on what you want to do, and then you did it right because it said put credit spread. So that means it's a put credit spread, and these are the options. I'm going to be short the 281.50. I'm going to buy the 281 put, and the same things for calls. It works the same exact way. So let's close these out. We'll sell the more expensive one. You can see these are now flip-flopped. You'll be selling the 281 and then buying the 281.50. So it's just flip-flopped. And this means you're short the stock. And the being short put was you're long the stock. So you get a 26% credit. Now, if you get a debit, that means you want to be in the money. What you're going to do, this is credit. So when I sell premium, when you sell premium, you always get a credit for it. And then you can hit continue. You can just do one. And what I will say is about the collateral, one thing that I will notice is they don't put a max profit or max loss here. It doesn't say how much you lose. So, hey, the maximum amount of money I can make is $26. How much can I lose on this trade? And the collateral they're going to take from you is $50. And what the collateral means is they're going to hold that buying power, kind of like just holding your margin there. Because if you do full on lose on this, they want to make sure you have enough money in your account. And now if I put this trade on, let's see, it was August 3rd, and see what the max loss is. So I had I'm short the 281. No, I'm sorry, I was short the 281. Just want to make it the same. So, and they're saying I'm going to get it 20. They're saying the mid price is 23 cents here, and over here they're saying it's 26. So this one is taking the mid price of 26 to 28, 23 to 28. And this one's just taking the bid over here. So they're saying right here my max loss is $23. So my max profit is $23. My max loss is $27 here, but they're going to hold $50 in collateral for me. Over here, where other brokers, they definitely take a lot less than this. So they're actually, Robinhood says when you put on a credit spread here, we're going to hold double the maximum loss just to be safe. And they do that just to protect themselves as a brokerage. Why they do that, I don't know, but that's just their rules. Every brokerage has different rules that they apply and different regulations that they apply as well. The other thing that I will say is you do get free commissions for Robinhood, but I will say when you're in a bind or you're in trouble or you have questions, they're not the best. You have to submit a ticket and then you have to wait, and they'll either call you back or there's a phone number, but it just takes a long time just because they have so many customers and they're understaffed. But a brokerage like Thinkorswim or Tastyworks, where you pay a little bit of commission for, they have staff that when you call, they pick up within minutes. They have a live chat. You can live chat them. You have a lot of people that are you can just call them and they'll be ready. And that's because you pay commission for people to be there to answer your calls when you have questions. Sometimes you'll get assigned stock. Sometimes things will get exercised, especially if you don't know what you're doing. So that way, when those things happen, you have someone to call, like at TD Ameritrade or Tastyworks. They have knowledgeable people that you can talk to. Say, hey, I had a short put spread and I was assigned stock on that put, what price can get out of at break even or whatever the case is, and they can walk you through that. For Robinhood, if you have that, you're probably going to get a margin call. You're going to get some nasty notice on there, and they're going to say, hey, do something about this or we will. And when they do it, it's their machines, not like an actual person. So just be mindful of that. Also, when buying premium, if you look at these August 3rd expiration here, if you look at the percent change on the calls and you look at the percent change on the puts, most these are all negative. And this is for expiration coming up close. If we go further out, let's just say till a month out, you'll see these are mostly unchanged and the calls are mostly unchanged. And the reason for that is these expire in 2 days, so not even today. They don't even expire today. But if I go to the SPY chart today, you can see the stock was only up it was down 47 cents. Let's go to the 15-minute chart so you can get an idea here. And a lot of people will say, you're going to buy some options, you'll have time just to make sure that you have time. But you can see the people are holding. If you were holding this yesterday, a call or a put, you would have lost money. So if you held a call yesterday out for this August 3rd expiration, you would have lost money. If you held a put, you would have lost money. The people that win here are the option sellers. So just be mindful of that when you're this close to expiration, Robinhood doesn't do a good job of telling you this, but when you're this close to expiration, I don't even think, they do have theta here, but when you're this close to expiration and you're out of the money and then the stock doesn't move. Now, if you day traded this chart, you probably could have made some money. So if you had the 282 put here, let's say you bought the 282 put, you would have made a couple bucks there, 100, 200 bucks from it dropping. But if you held from yesterday and until today, it didn't matter if you had a call or a put. Obviously, the calls lost a lot more. But if you had a call or put, you wouldn't be making any money. You most likely lost money today on these trades. The way to make money on these trades is, like I said, if you're going to trade this close to expiration, you need to have the timing right and you need to play the chart right. You can't just buy something and hold it and hope that you make money, because you're most likely going to lose money, because you can see here all the positions lost money from yesterday, same as the day before. And if it's out the money, even worse. Some of these are probably like 90% losers, 75%, something like that. So this is just some tips there. When selling and buying a spread, remember your probabilities when buying puts and calls. What you want to do is if you want to day trade this, buy something that's closer to in the money. Just buy the one strike that's right outside the money. It'll be cheaper, or two strikes outside the money. So here you could have, at 282, you could have bought the 281.50s. And I can show you you can't actually look this up over here, but let's look at what that pricing would be for a put, 281.50. So, like I said, the 281.50s when it was skyrocketing, it hit a low of 65 cents. And then it hit a high of 161 when SPY bottomed out today. So it was a couple dollar drop, and like I said, he made a couple $100, but it looks like he would have only made about $100. However, you did get 100% return, 50% returns if you took that trade off. So that's one way that you would trade it there. It wouldn't be great to trade, something so far out of the money that you don't really make any money. But just be mindful of that. If you have questions, definitely leave a comment below. We actually also started an options trading group. It's a free group. Sign up. There's a link below. All you have to do is join. It's on Facebook. If you have any questions, just let us know. And if this is your first time here, you found this video to have value to you, please subscribe so that way you get the notifications. We do a lot of live videos. And if you like the video, just hit the like button.